What if I told you that you could become a millionaire investor without ever picking a single stock, timing the market, or reading a single earnings report? Sounds like a dream, right? But it's not. This is the power of passive investing, a strategy that's simple, low maintenance, and proven to outperform most active investors over the long run. In this video, we'll break down the lazy investor's blueprint. How to build long-term wealth using index funds, automation, and a few smart habits. Whether you're just starting out or looking to simplify your portfolio, this guide will show you how to invest smarter, not harder. Before we dive into the strategy, let's talk about why so many people struggle with investing. First, they try to time the market. Buying low and selling high sounds great, but in reality, even the pros get it wrong most of the time. Did you know that missing just the 10 best days in the stock market over a 20-year period can literally cut your returns in half? It's true. Second, people love to chase hot stocks. We've all seen it. The meme stock craze, the crypto hype, the next big thing. But by the time the average investor hears about a hot stock, it's usually too late, and they end up buying at the peak. And finally, people overcomplicate it. They get bogged down with fancy strategies, constantly rebalancing and watching the market like a hawk. All that does is create stress, not wealth. When it comes to investing, simplicity is your superpower. So, what does it mean to be a lazy investor? It's not about being lazy in a bad way. It's about being efficient. It's about focusing on what actually works and tuning out all the noise. The core principles are simple. Invest consistently, not just when you think it's the perfect time. Diversify broadly so you own the whole market, not just a few companies. Keep your costs as low as possible because fees are a silent killer of returns. And most importantly, stay invested. Time in the market always beats timing the market. And the secret to making all this effortless? Automate everything. The heart and soul of this entire strategy is something called an index fund. Think of an index fund as a basket of stocks that mirrors a specific market index, like the S&P 500. So instead of trying to find the one winning company, you own a small slice of all of them. Why do index funds work so well? First, instant diversification. You're not putting all your eggs in one basket. If one company has a bad year, you're cushioned by hundreds of others. Second, they have incredibly low fees. There are no high-paid fund managers making constant trades, which saves you a ton of money. And finally, the performance is proven. Historically, index funds have outperformed 80 to 90% of actively managed funds over the long term. Some popular index funds to know are S&P 500 funds like VOO or SPY, which track the 500 largest U.S. companies. Total stock market funds like VTI give you even broader exposure, and you can add international funds like VXUS for global diversification, and bond funds like BND for stability. Now, where you invest is just as important as what you invest in. You want to use tax-advantaged accounts to supercharge your growth. If your employer offers a 401k, especially with a company match, that's free money you should absolutely be taking. For individuals, an IRA is fantastic. A Roth IRA is especially powerful because your money grows completely tax-free. Once you've maxed out those retirement accounts, you can use a regular taxable brokerage account. And don't forget about the Health Savings Account, or HSA, which has a triple tax advantage. It's a secret weapon for long-term investors. So, how do you put it all together? You don't need 20 different funds. A simple 3-fund portfolio is a classic for a reason. It consists of a U.S. total stock market fund, an international stock market fund, and a total bond market fund. That's it. You get global diversification and stability in just 3 easy steps. Want to make it even simpler? Go for a 1-fund portfolio with a target date fund. This fund automatically adjusts its mix of stocks and bonds based on your age, becoming more conservative as you get closer to retirement. It's the ultimate set-it-and-forget-it option. A good rule of thumb for your mix of stocks and bonds is the 110 minus your age rule. So, if you're 30 years old, you'd have about 80% in stocks and 20% in bonds. Now for the magic step, automate your contributions. Consistency is everything, and automation removes emotion and forgetfulness from the equation. Set up recurring transfers from your checking account to your investment accounts. Have your 401k contributions come directly out of your paycheck. This strategy is called dollar cost averaging. By investing the same amount regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. It smooths out the bumps and builds discipline. Another key step is to reinvest your dividends. Many companies pay out a portion of their profits to shareholders. That's a dividend. Instead of taking that cash, set your account to automatically reinvest it to buy more shares. This is called a DRIP, or Dividend Reinvestment Plan, and it's a powerful way to compound your returns over time. Okay, this next part is crucial. You have to learn to ignore the noise. The financial news lives on fear and hype. Reacting emotionally to scary headlines is a recipe for disaster. Stop checking your portfolio every day. It's not a video game. Don't panic and sell when the market drops, and don't jump on the latest trend without thinking. Instead, check your portfolio once a quarter, or maybe even just once a year. Trust your plan. And remember, the market has recovered from every single crash in history. Let's talk about fees for a second. They might seem small, like 1%, but they can destroy your wealth. An index fund might charge an expense ratio of less than 0.10%. An actively managed fund could charge 1% or more. That difference is huge. A 1% fee on a $100,000 portfolio over 30 years can cost you over $100,000 in lost returns. That's why you want to stick with low-cost providers like Vanguard, Fidelity, or Charles Schwab. The final and most important step is simply to stay the course. Investing is a long game. The biggest gains come from decades of letting your money work for you. This is the magic of compounding. If you invest just $500 a month and earn an average 8% return, you could have over $745,000 in 30 years. The earlier you start, the more powerful compounding becomes. You don't need to beat the market. Even the legendary Warren Buffett recommends index funds for most people. Think it's impossible? Let me tell you about Ronald Read. He was a janitor and gas station attendant who lived a simple, frugal life. He quietly invested in blue-chip stocks and index funds for decades. When he passed away, he left an $8 million fortune to his local library and hospital. He didn't have a finance degree. He just invested consistently, reinvested his dividends, and stayed the course. To get started, you can use robo-advisors like Betterment or Wealthfront that do all the work for you. Or you can use DIY platforms like Vanguard or Fidelity to build your own simple portfolio. So let's recap the Lazy Investor's checklist. Choose low-cost index funds. Automate your contributions. Reinvest your dividends. Ignore the noise. And stay invested for the long haul. That's it. No complicated charts, no stock picking. Just simple, consistent action that will build you serious wealth over time. Your future self will thank you for it. Thanks so much for watching. If you found this helpful, please hit that like button and subscribe for more simple strategies to build your wealth. See you in the next video.